Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 99. Big Wayne. As always, joined by the three amigos. We got Keith Dicker, IceCap Asset Management, Rich Diaz, Tom Brady of Macro. Welcome back to the show, gentlemen. Keith, where are you?
I am in Waterloo, Ontario. You can picture that. So myself, Mrs. IceCap, we are dropping off or delivering Junior to University of Waterloo, his first year of college. So here he is. He's starting day one. Next week, I guess it is.
That's studying?
He's pretty sharp. He's going to do actuarial science kind of program down that way. Rich is not. Rich is drooling there now. He's like, wow, data stuff.
It is cool.
Yeah, but it opens up a lot of opportunities. We'll see where he goes with it. But that's what he's thinking.
Future governor.
The cool thing about Junior, he's smart and he has Mrs. IceCap's looks. But guess what he inherited from me?
The size?
His funny jokes?
The sense of humor.
Bad jokes.
What about you, Rich? What's going on?
Oh, not much, man. It's finally a nice week in Montreal. It's been beautiful weather. On the 28th of August in 1963, Martin Luther King Jr. delivered his I Have a Dream speech. And every single year, I have done for many, many years, I always play the whole thing in its entirety. And we're not going to bore you guys with that now, but I think you should definitely play that for yourself. It's on YouTube. So I always make a point of sharing that with my friends and family. And otherwise, that's it. So yeah, go listen to Martin Luther King Jr.
That's quite the ritual.
Speech.
I'm not going to lie.
It's a good ritual.
One.
Judge people.
What was your favorite line? What was your favorite line from the speech?
Judge people not on the color of their skin, but on the content of their character, which is something I take very, very seriously. He was an incredible man, and I felt the need to share that with you guys today. So let's talk macro. But yeah, go listen to the speech. He's an amazing guy.
There'll be lots of judging of character on this episode here today. So we can start that one up with CIBC's Benjamin Tal was out this week here. So he's the chief economist at CIBC. I think really actually a really astute guy. I think his research is some of the best in the Canadian banking world. And so he was, I believe, at that housing retreat in Prince Edward Island last week. And so apparently this is now just surfaced out, but Stats Canada and the federal government, per Benjamin Tal's research, has been undercounting and underreporting non-permanent residents in Canada. He says over the past year, they've underestimated by 1 million people. So a very, very small rounding error on the part of the federal government. Of course, he basically put that together saying, listen, guys, like you guys are grossly not only undercounting, but that's also exacerbating, of course, the housing crisis, which we've talked about on this show ad nauseum. And so really kind of brings to light, I think, the challenges that we're facing today as a country, strained infrastructure, horrible housing market conditions. And part of that is bad data, really bad data. Rich?
I didn't do it. Don't blame me.
Well, they should hire Acorn. What's going on here? This is horrible.
Well, we'll see what happens there. But I have a question about how he can you elaborate on how he concluded it, or what? And because I've noticed that there hasn't been any pushback from StatsCan. I think that they've said, "Oh, it's a mea culpa." That they agreed, right? So
StatsCan, like there was no rebuttal. Like, yeah, they just took defeat and said so. They're coming out with a quote unquote new and revised methodology as starting next month about how they're going to count non-permanent residents. So they have admitted defeat, and it was a really, really ugly one.
God, it can't be that hard. You used to, were a kid, you go to one of the fairs. We used to have them called Thomas Amusements where I grew up. used to go on the scrambler. Remember that one? It was going crazy. You thought you were going to hit the other kid in front of you. You turned to the last second.
No, is that
Well,
is that
before you
the
got on the
bumper
ride, though,
cars?
it's
Bumper
something like
cars?
that. But before you get on the ride, the dude who did not have a PhD in accounting or anything, he didn't go to Waterloo, put it that way. He had a little clicker.
Oh yeah, like in the clubs.
Yes, absolutely. So when you go on, he'll click it, and you got the number, and he knew he was full. So see, maybe StatsCan or
Well,
the
I'm
border
sure they sell that on
control
Amazon.
guys.
Let's
There
just
should be
ship one to
something they can
Ottawa.
do. But jokes aside, guys, we're chatting earlier. Um, this is a significant error. It really truly is. So anyone out there now, they're stretched where they can't even find a place to rent, and if they do find a place, it's 50% more than what their budget was. Like, this has pushed a lot of Canadians off sides financially. It's created an enormous amount of stress in our society, even amongst relationships, I'm sure. And I hope this doesn't get just washed along. They send out a revision on it. But I know you can't go back. Well, this person made an error. But again, to miscalculate by it, is it a million that you said, Steve? I mean,
A
that's a
million people.
pretty,
Yeah.
yeah, it's enormous. It's enormous. So
So
I
I
don't know.
can, yeah. So I mean, to Benjamin Tal's point, it looks like so they've averaged, it looks like about a million people, and yeah, basically under. Anyways, the long story, I think he was saying we hit 2.5 million people last year or something like that. And it was some egregious number. I don't have the report in front of me, but anyway, StatsCan has admitted defeat. And that kind of brings you to the housing affordability issues, which, yeah, again, despite mortgage rates,
Hey, Steve, just back up to that for a second for that story. I wasn't aware of it, by the way, so thank you for sharing it. What else? Like, what did he add on as a narrative around it, or what else did he share with that information he found?
well, it's just like, hey, listen, like if you guys are planning, if the federal government or provincial governments or municipal governments are trying to sort of plan for how much housing construction or housing completions that they need, and what is the right number of new units to be built. Well, I mean, all of those assumptions are based on horribly flawed data on your population growth. So, and again, this is what I think, like, you know, there's one thing with data, Rich, and I'm sure you can appreciate this more than anyone. What's like, I think it was what Jeff Bezos said that once at Amazon, where it's like sometimes, like, if the anecdotes don't line up with the data, a lot of the times it's like the anecdotes, you almost want to listen to the anecdotes. And so if you see this data, you're like, the anecdotes have been pointing very, very squarely over the last 12, 18, 24 months that rent growth has been enormous across the country. You see all these TikTok and YouTube videos of people lining up around corners to go see rental properties. I mean, it's just something's not right, right? And so it's unfortunate again that decisions are being made on horribly flawed data. Again, think about this. I mean, if you're the Bank of Canada, right, trying to figure out how much to raise rates or not raise rates, and you've got, you're looking at StatsCan data. Like, look, I mean, we've talked about it on the show many, many times, which is like the jobs data. Stats Canada is prone to massive revisions. The jobs numbers are all over the place every single month, highly volatile, and so it's you're making huge policy decisions on the back of data that is questionable at best. I know they're doing their best job, but I mean, missing by a million people is a huge miss.
So it's cute that you think that they took any of this into account when they decided on their immigration policy, because if you'll remember, I think last year, I mean, not to pump tires here a little, but we were on this very early because I look at the data and one of my neurotic habits is to just dig and dig. And we noticed that population growth was ripping. And at the time, people were we were derided for that view and said, and so so they did not think about how this was going to impact the economy in Canada. I can guarantee you that, or else they wouldn't have done it. And maybe they would have done it anyways. But the other thing I think is important for Canadians to know is, like, not all statistical houses were created equal. And I would say Here's my PSA, my public service announcement. I think Canada should spend a lot more money on its data, because there are countries like, for example, the US, that have incredible granular data for every single state, even counties within the state. You have house prices or job growth or the type of job in the particular state. And for all the faults America may have, there's and some of the criticisms warranted, some of it's not warranted, but their data suite for understanding the economy, the good, the bad, and the ugly is incredible. And Canada absolutely lags behind, especially for a rich country, especially for people who, espouse to be, one in the G7 or what have you. And so that's something we should definitely, I don't know. We know a couple people from Ottawa listen to this podcast, so to take some notes and allocate some of that pork barrel spending to StatsCan.
So maybe you target 2% of GDP. That doesn't go to NATO. We put it to data.
No, NATO's a good idea.
Collection.
Come on, Vivek. Let's not get down that road.
We're not doing close to that. It's interesting, Rich, because data is, we always need data to analyze what we've done, what trends are, looking forward, things like that. I mean, that's what my world is. That's what Steve's world is, and yours as well. I think it's a great point. Again, though, someone dropped the ball here. But for you to pick up on this, say 12 months ago, it meant that the data was there.
Yeah, it was.
Right? Because I know for a fact you're not at the, you don't have your clicker going click every time someone comes in. Which, by the way, that might be a better idea, the way to do it. I assume that data was already known. And yeah, of course, people in Ottawa listening to this, I mean, come on, guys, there's been a significant major error and blunder with policy coming out of Ottawa. I don't know if it was 4 years ago they started this or 18 months ago, but there's an enormous gap there. And people like to talk about, other big challenges we have in our economy and system today. But getting this so wrong, it's not that it was wrong to increase immigration, let the numbers come in. It was wrong not to let anyone in charge of infrastructure to be aware of it. Say, hey guys, we need better roads now. Healthcare, we need to expand that in some way. And you go on with that. And again, and you can't put that genie back in the bottle, because if you did stop it instantly, it leads to other unintended consequences. Remember that one from last week, or was that the week before?
Sorry to interrupt the show. Just want to let you know this episode is sponsored by Addy. Addy is an online investment platform that enables everyone to invest in institutional-grade commercial real estate. They're the largest real estate crowdfunding platform in Canada. You can invest as little as $1 to start. I've personally invested in several properties on the platform, and they'll be launching a new property shortly. The next one is 20 townhouses in Calgary that are fully rented out or ready to go. Addy is free for investors to invest, but they also have the addyONE membership that gives a handful of benefits, including advanced access to properties, exclusive events, and more. Loonie Hour listeners can use the promo code Loonie Hour for their first year free on the addyONE membership.
The new immigration minister was Mark Miller. I think it was last week. He stated in a public advertisement in the media there that the level of immigration, or the issues that it's creating are threatening the integrity of the immigration system, which is basically, in particular, these foreign students coming here and basically using these colleges as a way to expedite permanent residency. And so anyways, there's a lot of issues to unpack. We can meander along about it, but that's the issue. I mean, again, another own goal, it seems, but that brings us kind of to the next point, which is, of course, when you start undercounting and we have run into these housing issues. So per BMO Economics, they wrote a report out this week. So BMO Economics denotes that this is the worst housing affordability in the Canada on a nationwide basis since 1988. Keith, you're much older than the both of us, but it's fairly well documented. The late 80s in Canada and the housing demise that followed shortly thereafter. So, perhaps an interesting setup moving forward.
Yeah, well, I was 48 back then. I remember that, and No, but it's, it leads into one challenge after the other. But the biggest challenge that Canada had back then, which I think it's interesting because back then it was a commercial real estate problem. It was basically in Toronto, in the GTA area, and where a lot of these commercial properties went under. One person's liability is someone else's asset. So several of the insurance companies went under during that time. So they had like one company is called Confederation Life. You guys wouldn't even be aware of that. But I know we know one went under. Royal Trust was another big name. They had a big challenge in that space. So once a bank's balance sheet does get impaired, or one person's liability, which is someone else's asset, becomes impaired, it creates a pretty dark hole out there. But that was just really because back then, Canada was Canada. Vancouver was not booming. Kitsilano was just a little beach. That was it, Steve. Montreal was, it'll always be Montreal, but it was Toronto, right? That was it. Canada today is much different. So I think today it's incredibly, depending on which side of the trade you're on, it can be frightening or exciting. When it doesn't have to be one or the other, if you're positioned properly. But that sort of leads into at some point today we'll talk about the bank earnings that have been coming out.
Yeah, we get to the bank earnings. But
wait. What's important to remember about that affordability thing is that interest rates were 3x. So you're having the worst type of affordability, but interest rates in the 80s, I don't know, I was 4 years old in 1989, but the 10-year bond yield was like 10%. So it's just incredible. So not only just think about how so the affordability is partly an interest rate thing, but it's also partly the house price thing, which is incredible. It's absolutely nuts. So I just think that's so that's also the part of it that's I think really crazy.
Well, let's not forget interest long-term rates in the early 60s went from 4 or 5% all the way up to nearly 20 by 82.
Yeah.
The early 60s, 82 was a horrible time to be, a buy and hold and prosper investor. And then from 82 to 08, 09, rates went straight down. But there's a few hiccups, of course.
Keith, I know you.
And now we're going up, guys. I didn't finish it, Steve, but now we're going up again. So
I don't want to hear this. But I know you mentioned the commercial side of things. It's interesting. I do wonder though if we are on the precipice of another, commercial real estate crisis. Obviously, it's not just a Canada specific. We've talked a lot about the office, but I mean, I know like Toronto, Vancouver, those two markets in particular have been dealing with, office space that hasn't recovered, right? And a lot of these buildings are just going to hand the keys back over.
There's no bid. So one of my best friends' brother, one of my best friend's brother, hopefully you guys can hear me now, is a really big deal at a brokerage firm for commercial real estate. And he's saying that the haircuts are 20-25%. And the customers are not happy. And the truth is, even if people wanted to buy them, the financing is just so restrictive. Not in the sense that banks won't give them money, is that they're asking for huge spreads, and the interest rates and all-in interest rate costs are much higher. And so,
Rich, why don't you explain to everyone who's listening what like a haircut means, and maybe how like the spread might work, but don't go too rich deep, Like, you know what I mean?
30 seconds, go.
10 seconds. Okay, so a haircut basically is just a fancy word for saying that you're getting a discount on a potential asset. So normally bonds sell at par, let's just say, and instead of buying a bond or a liability, whatever you at 100, you might be paying, you only pay 80 cents in the dollar. So that's a haircut of say 20%. And the spread is just the extra premium that a lender will demand on, let's say, the cost of a risk-free bond. So let's say Canadian government bond yield. So for example, right now in the US, mortgage rates are 7%, and the 10 and the 30-year bond yield is, let's say, 4%. So that 3% spread over the mortgage rate is like a 30 or 40-year high. So there's some, like, obviously some tension, there's some stress in that market. There you go, 30 seconds, not bad.
Well,
that's acceptable. I like that.
So yeah, it'll be interesting to see. I mean, on the residential side, if you go back and look at Canada's national average home price. So we have the data going back. I mean, they pretty much bounced around, but more or less went sideways for a decade in the 1990s. So again, don't know, not a prediction of where we're going, but certainly, the worst affordability since 1988. Mortgage rates in the sixes. Maybe they come down a bit, maybe they don't. But that's probably another conversation for later on in this podcast. We have a lot of data that's coming through, starting to test the bond market. But Keith, I know you've been following it really closely, tweeting about it. People are anxious to hear your comments on the Canadian bank earnings this week.
Yeah, so I think now we've had all six of the big banks have come out. And so if you're not following that story, there are maybe 3 or 4 quarters ago, we started really covering it. Every quarter, a bank, they release their earnings. And, for earnings, you have your revenues coming in and your costs. And one thing banks always have to try to account for is, how much of the mortgages they've lent out, how much won't be paid back to them. And it's always a bit of a probability game. But when times are great, they will claim very little money will not be paid back. So your expense for bad loans is quite low. And then when things start to get a little bit tighter, they have to start increasing that number. So we've been, the Loonie Hour, because we're ahead of the game here usually. But about a year ago, we started, talking about this. And one thing that we said was, hey, one thing to keep track of to identify if the Canadian economy is slowing is how much are the banks starting to provision for bad loans. And it's not the actual number that is important, is what was the number they put out compared to the previous quarter? What was it from a year earlier? Or what has it been relative to the last 10 years? So remember, from 08, 09 to 2020, rates were effectively at 0%. There was no recession. The economy was booming everywhere, and that's it. And now what we've had over the last maybe 4 quarters, I'm thinking now, all of the Canadian banks have been increasing their bad loan provision every quarter. Some of them have been very aggressively increasing that provision, and others have increased their provisioning more than what even analysts were expecting.
That's what I was going to say.
Yeah, so there's another angle with this as well. So in my mind, the way that we look at our portfolios for clients at IceCap, this, remember, the world doesn't always move in abrupt changes. You get sudden, slow turning changes, and then by the time it's completed, it's 180 turn. They're caught off guard. Whereas we would say, well, you could see this turn starting to take place a year ago. And that's what continues to happen right now. So, you always wake up in the morning. Is there a reason to change that view? But from a bad loan perspective, which indicates that either households or companies are finding increasingly more difficult to pay back on their loans, what they borrowed. So whether it's a personal loan or corporate loan or small banking loan, for example, or mortgages, that data is continuing to play through. And if I just have you for another part 2, is that right? Second part. People who are really following the story of the Canadian banks. So I think specifically it was Bank of Montreal and CIBC, I think it was. The big increase they've had in credit provisions or loan losses, things like that, you know, what they call it. It actually came out of their U.S. exposures. And within that U.S. market is what Steve was just talking about, is from the commercial real estate market, which also sort of points back to, remember a few months ago, we were talking about private credit.
Yep.
Do you remember that? So that's what the pension funds invest in. You know, they're lending money to companies or entities and structures that are not really going to market to do. They're doing it directly. And the valuation of that debt, when it comes, for your quarterly reporting, it's basically whatever you want to price it at. There's no market for it. So you're always positive. So that's why, like, the big pension funds in anywhere that we're doing in Canada, they've been talking nonstop about allocations of private credit. Our return the last 12 months was this, which beat our benchmarks, but was led by our exposure to private credit. I know Rich is smiling there right now, but that's because they just weren't pricing it correctly. And we've talked about that, hey guys, like, I think it was BlackRock or PIMCO Are they starting to offer retail funds for private credit? I think they were, weren't they?
God, I hope not.
Oh, they absolutely are. 100%. One of them is. It's either BlackRock or PIMCO, which, because they're evil, is probably BlackRock, so to speak.
But they got to offload the
uh,
risk, is what you're saying.
maybe like Big
Maybe.
Short kind of story. Maybe, baby. However, the point is, if you're always connecting dots, because the financial world is just money, like sloshing around, finding some place to allocate it, and once it catches fire, you yank it out right away. But now that we're starting to see Canadian banks, and specifically these two I just mentioned, a lot of the provisioning, I think, for bad loans is from that very market down in the U.S., which in our mind is just 1 to 2 dots away from connecting it to private credit, which means, again, we are headed towards this ultimate outcome, which I think we will talk in a second. Either the world continues to grow and be awesome, or it rolls over and it's not awesome. I don't think we can get anywhere in between. I think that's like a 0.1% probability, but that's why the Canadian bank earnings this week, they're so great to see, because you tend, all the big media guys, they say, oh, XYZ bank reported earnings, they beat estimates, and I say, who cares? Any
They
bank
always
can beat their
beat.
estimate.
Yeah.
Yeah, you just got to adjust this or that, but you start diving down into the data, and then you can, as we always talk about, it's the numbers are the numbers, but it's this is a loan, a bad loan story right now for banks everywhere around the world, not just the Canadians, but same with the Europeans, and the panda in the room, that this is the exact same problem they have. So I thought I was waiting for this week for a while. I think even 5 weeks ago, I was saying, hey, next week they're coming out with earnings, but I was so excited I missed it by a month. What did you see, Steve? What did you pick
I
up
want to
on
add
it?
some color. I want to add a little wrinkle,
Rich,
if I
you go
may.
ahead first. I
Sorry,
got
I'll
some
take 1
commentary.
second. But Keith, you'll like this. So there's another angle to this too, which is Keith, you're familiar with the Sharpe ratio. So some people might not understand, but Sharpe ratio basically is used for measuring risk-adjusted returns. So people will sell their fund and say, we're doing really, really well. If you make 50%, but you took on a lot of risk, you're actually not doing that well. In our world, in Keith's world, you need to adjust those returns by the amount of risk you take to make them. And the thing is, and because these funds are not marked to market, in the same way that you can basically say whatever your return is, you can also decide what your volatility is. And what they do is they always take a volatility number that's very, very low. So Sharpe ratio is your expected return divided by sort of some kind of volatility measure, let's say standard deviation. And so what they've been doing, Keith, is they've been keeping even though the market's crazy and a lot of these private credit funds are doing really, really badly, they've been keep holding down the volatility number, and so their Sharpe ratios are still really, really good. And it's just, I think it's just, it makes me laugh because I guess I'm a nerd, but it's just too funny. So you have all these funds and all these like the pitch decks with these amazing Sharpe ratios, these bogus returns because they're not marked to market, and just these cleverly, anyways.
So what I love about that, and again, people may not realize this, but the biggest influencer, one of the largest group of money managers in the world, they're not even money managers. Like they're not even licensed to manage money, but it is the consultants out there. So they're the ones that direct pension funds how to allocate money and where not to allocate money. And how do they come to those decisions, Rich? With the bad data you just talked about,
yeah,
right? They would say, well, it's not bogus, it's data they're collecting. But I guarantee you there are a ton of pension funds out there right now, not just in Canada, but everywhere around the world. And they have exposures. They have no idea what they're backing into. Yeah. And it might, maybe they don't have to mark them properly for a full cycle, and then they'll be okay. But if you get permanent losses in these credit markets, which I suspect has a high probability of happening, there's going to be a few consultants losing their jobs. A few pension fund administrators will finally wake up and say, "Oh wow, it's not our fault. We invested with these guys." But this is a big story out there. It's pretty. Again, if you're an investment manager right now, you're in this field and you're not excited when you wake up in the morning. Oh boy, move to Kitsilano and get into a different market.
CIBC, yeah, they reported net income fell 15% year over year. But yeah, Keith, to your point, the big number was the total provision for credit losses increased 203% from last year. So a pretty big jump. It's the change of direction that is perhaps most alarming. But there's one other thing here which we've talked about on the show is the amortization issue at these Canadian banks. So amortizations that are longer than 35 years.
Crazy. Indentured servitude.
Yeah. So basically, you have TD that is running 23% of their book with amortizations greater than 35 years. RBC greater than 23% as well. BMO, we only have greater than 30 years available, but that's at 30%. So 30% is greater than 30 years. Now, again, keep in mind, you can only contractually sign a new mortgage with a 30-year AM. You can't have a 31 or a 35 or a 40-year. Those are long gone.
Less? Can you have less?
You can do 20. You can do pretty much whatever you want, but like the standard in Canada is like 25 or 30 years. It's like most typical, right? So if you have a 35 year, for example, or greater than 35, that's telling me that these amortizations, the only reason why they're extending out is because it's people that are trapped in these variable rate mortgages that really aren't paying any principal down. So
they're bonded. They're like Irish farmers owned on land owned by the British in the 1800s. They're like bonded workers.
Yeah.
Oh,
so
boy.
Hey, Steve, I have a question for you about this. So let's just say I have one of these variable rate mortgages, and I've had to have the amortization period extended from 25 to 35, whatever the number is. And let's just say the term comes up now next week. How does this get reconciled back to another 25-year term, or am I able to keep it at that 35-year term or higher? Or is this a question for a mortgage guy?
Yeah, so on renewal, right, you're supposed to get back into your contractually obligated term, right? So if you signed a 30-year AM and it blew out to 50 years, let's say, and 5 years go by, now you're at, the remaining life should be 25. So you're technically supposed to renew, you're supposed to fit the remaining balance into 25 years, right? Because you went from 30, now you're 5 years later, you're into 25. So you have to you're going to end up with like a balloon payment, right? Because you have to fit this like larger balance in 25 years. Now you can extend it back to the legal obligation. You can extend it back to a legal 30 years, but you still have to fix. So now I think I think the problem is maybe like a little bit overblown in the fact that like what we're seeing is a lot of these issues are being rectified in people just converting to fixed rate mortgages.
But
so
at the top,
let's say,
though, at the top of the cycle, they're converting rates at the top of the cycle.
Correct. Yeah. And so they're basically self-enforcing these rate hikes.
It sounds like a market call by both of you guys.
No, I didn't mean that. I meant they're locking in rates at 6% instead of
20-year. I mean, it's 20-year highs, right? So I mean, you're you're seeing people who are going, I can't take this psychological pain anymore. My amortization's at like 70 years, and so I'm gonna like convert this to a fixed rate mortgage, and that basically the problem essentially disappears. Now there's other ways to disappear. You could basically you could sell your property. It's a variable rate mortgage, so you pay your 3 months of interest and the mortgage is gone. When you go to there was a lot of ways I think these problems will get rectified. I'm not saying it's not a real issue. It clearly is. I mean, these are basically non-conforming loans on the bank's balance sheets. So it's a real issue. CIBC here, 25% of their book is greater than 35 years. The only two banks that don't have this issue are essentially National Bank and Scotiabank, because they have a true floating rate mortgage. They have a true floater that moves when the Bank of Canada and prime rate moves. So that's what we're seeing. And this is really like an issue that I think is going to be a larger issue 2 or 3 years out, assuming that rates hold near these levels.
But this also ties into, I think, the next conversation that we'll have, whether, we do get a soft landing or not. Because if we get a soft landing, like, it'll get worked out. They'll come up with new structures for everyone. But if it's not a soft landing and we go into a hard landing, which is a recession, by the way, that's what we're talking about, and it happens very quickly, it's going to put so many people off sides anyway, because this time it comes from job losses. It's not from rates going higher. It's from the job loss side. Or if you don't lose your job, maybe that second job you take, that's not paying out anymore, or your partner loses money, like not getting paid. And this is what the banks are worried about. So it's one thing to have, okay, rates are going higher, but everyone's still working. They're making their, they continue to make their payments that way. But if I'm the banks right now, and again, we talked about, they're raising their credit provisions for bad loans and that stuff. I'm telling you, if we get a recession coming up, and no one believes it's going to happen, but that's what makes it even more frightening, or again, exciting, depending on which side you're on it, which I guess will also leads us to, we have a Bank of Canada meeting next week. So we have a bet. Do you want to do the bet now?
Yeah.
So I know Rich is like dying there.
Got the
Rich
box ready.
You got a box ready?
We're not eating them now.
We're not doing it now.
September 6th.
We're gonna bet now. We're gonna eat them later. Well, you're gonna eat them later. I'm gonna.
I think Rich is sorry. Steve is just hungry. He just wants to chow down.
Oh man, it's a long weekend coming up here. Lots to look forward to. Obviously, post long weekend, we're gonna get back into, like, I think people coming off vacations, and markets starting to get a lot more interesting, and then we'll be queuing it up with.
So let's set up the Bank of Canada meeting. So they're meeting next Wednesday.
Yep.
And that's Tuesday hour of the Loonie Hour. Is that right?
September 6th. So we'll have a full coverage of the Loonie. Hey, full coverage of the Bank of Canada presser September 6th for next week's episode. It'll be our 100th episode. So Tiff Macklem blessed us, with the important update there. He actually circled it on the calendar. He knew it was a 100th episode that week.
Did you see the video? Did you see that video that's been going around with Tiff Macklem and the Childish Gambino and This Is America? I would just recommend just Google.
I have not seen that. Now I'm curious.
Dude, it's amazing. It's amazing. Anyways, it's very funny, and it's a bit gory, but it's hilarious, and it's in good taste. I would recommend you guys.
You have to
Google
send that to me off the record.
I will do. Yeah. Okay. Will do.
So, Keith, you want to take the first stab at it?
Yeah. So to set up here, pretty sure we're at 5% right now, correct, for Bank of Canada overnight rate.
5.25, isn't it?
Are we at 5 or 5.25? Where are we?
Jesus.
We're at 5. We're at 5.
Come on, guys. It is 5. It is 5.
It's 5. It's 5.
It's just been so many, I can't keep track.
I don't get embarrassed, but I wouldn't, like, a little bit. I would have felt bad anyway.
Well, you know what? If he ratchets up another 25 next week, I mean, that would be an official 500 basis points, a clean number for him.
Yeah.
So maybe he wants it.
It's like Wayne Gretzky, 50 goals in 39 games.
500 beeps in.
I was watching there was a Bobby De Niro movie from years ago. Ronin, that's what it was called.
Great film. Great film.
Yeah. And this one scene is he's chatting with Jean Reno. He's the actor in the conversation.
Renault, maybe.
Reno. He's from Vegas.
He's French.
he's sometimes. Anyway, he asked Bobby De Niro's character. He said, like, have you ever killed anyone before? Because that's the genre for this movie. And De Niro looks at him and says, let's just say I hurt someone's feelings once before. That's what I'm saying. So back to the rate decision coming up. Will Macklem hurt someone's feelings or not? So we're at 5. So again, the setup for everyone to know. We've now had about 6 weeks since the last meeting, I'm assuming, somewhere in that range. Some data's coming out. Some of it's a little bit in support of more rate hikes. Some of it is not so much. The world collectively is at this Inflation's still a little bit sticky. Growth is getting slower and everything. So the banks are in this position right now where it's, do we do another one or not? Unbeknownst to the Loonie Hour here right now, because it is Thursday. We record on Thursdays. It's Friday for all the keeners that are listening immediately. There's a Canadian GDP number coming out on Friday morning. So that's already out by now. And that's going to provide a key piece of data for the Bank of Canada for next week. And it'll show whether, hey, the economy, it's doing okay, or it's slowing down dramatically, or it's still rising aggressively. So we don't know that piece right now. But based on what I see right now and what I anticipate and what they've told us, remember the Bank of Canada, they're so volatile. They're unpredictable. You never know what they're going to do. They say one thing and then the week after it's something different. But it seems to me like they won't be doing any rate decision. Sorry, it will not be a rate hike next week, nor a cut. They'll stick at the 5%. Put me down for 5.
Boring.
Okay.
Rich?
I think they're going to raise. I don't need to give you a whole boring preamble. I think that the fact that population growth is one reason. We know that rents are going up. We know that the core CPI, the preferred measures of core inflation that the BOC ignored when they were rising, I don't think they can be ignored right now. I think that part of the reason why the BC premier sent the letter asking to not raise rates is because I feel he probably knew that they are going to raise rates, and he wants to be seen to be on the side of the people. And also, I think the most important reason probably is because I think the U.S. is going to raise rates, and I think
did you just call an early leak? Does David Eby have the leak?
I don't know. The premier has a leak anyway. But no, I think that because the U.S. is not done, I don't think Canada can be done.
You think a Canadian premier, a provincial premier, has the nod ahead of the market?
Of course not.
For a rate hike?
I'm just teasing.
Oh,
of course
dear.
Not.
Steve, what are we going to do?
Him a couple bombs over WhatsApp, eh?
That's right.
What are we going to do with this guy?
So that's it. But the main reason is because I think the U.S. is not done. And so I don't think Canada can be either. What about you, Steve?
I'm gonna go. I think David Eby is his threatening letter has scared Tiff Macklem. No rate hike from the BOC. For those of you who aren't quite aware, so the BC Premier David Eby sent a letter. This is as of August 31st here. Sent a letter to the Bank of Canada urging them not to raise rates. He says in his letter, quote, in your role as governor, I urge you to consider the full human impact of rate increases and not further increase rates at this time. Anyways, he basically said that people in BC are in pain, so don't raise rates. So I think David Eby, he's a big dude, man. He's 6'7". I think Tiff Macklem gets the threat.
So I have a question. Did David Eby
send
a letter
6'7"
when...
Wait, whoa. So a 6'7"
about $1.80
premier, that's going to cause one of the world's major central banks not to raise rates?
That's Steve's
6'7"
theory.
Maybe.
Okay, can I ask my question?
Maybe
now?
if it was 6'8", but not 6'7". I don't know.
I mean, to be honest, he's a pretty he's about 180 soaking wet. So to be honest, he's really not that threatening. Sorry, Dave, if you're listening to this, but
Macklem, he looks like he can handle himself too.
No, he doesn't. Wait, did David Eby send a letter when they kept interest rates depressed forever and the house prices ripped and pushed people? What was it? The real cost?
Not.
There's a real cost to keeping interest rates way, way too low. And I just wanted to make sure if he had written a letter about it.
I mean, let's
How
be honest.
dare you? How dare you? The hypocrisy. Stop it.
I mean, hey, Keith, this is a good point. Actually, you've written. I think you and I actually originally connected off of your reports, but I remember you writing the report, and we actually had, I think it was some of our first ever Loonie Hour episodes was around you during the pandemic time, talking about the provincial debt. And the reality is finances in a lot of these provinces are not that good. And, we remember what happened during the pandemic, right? The Bank of Canada had to come in and buy a whole bunch of provincial debt to support that market.
I think that's the way it'll work out again. Like I suspect that the probability of a sovereign debt crisis is pretty high. And once it develops, the central banks, including the guys we have here in Canada, they will immediately rush in and they will support the federal bond market as well as the provincial bond market. Corporate debt will just get slaughtered. And what happens to the currency, Rich? Where does it go?
It goes down.
It goes south.
Where's the US dollar go?
It goes
north.
up.
See the irony?
We're going to
Canadians
switch
go
spots.
south, Americans go north. Yeah.
So that brings us to the next discussion here, which is again, maybe the Bank of Canada is looking at this, but we've had some data, Rich, recently out of the US here, in particular. Some JOLTS numbers. I think we had PCE today. We had challenger job cuts, a whole bunch of data that has kind of sent the bond market into a bit of a tailspin.
Tizzy. I think they call it a tizzy.
I was going to say tizzy. I went with tailspin, but
tailspin's good too.
You get the point.
Yeah,
I would say tizzy as well. I would have said tizzy.
Thanks for chiming in there.
I think we're like 20, 25 basis points off the highs of 430 or 432 or whatever it was. The JOLTS, which I'm not even going to attempt to expressing what the hell that means. It was actually really, really kind of a knockdown number. So I think, and the numbers the previous month got revised, and it was basically across the board. So the way they do JOLTS, they don't do this for Canada, sadly, is they do they have it by region, so Northwest, Northeast, South, and the other one, Midwest, and then they also do it by industry. So the industry group, so financial services, construction, manufacturing, whatever, basically they all sort of came down. Some of them were already quite flat. So like business, professional and business services were already quite flat. So that's there, but they all came down. But the thing is, there's different stuff. But then, initial jobless claims, that's basically been flat. That's a weekly data, so it's difficult to look at that. The other stuff that I thought was interesting is something called the challenger job cuts. So the Challenger is the name of a firm, a consulting firm that does research, and basically they calculate the number of job cut announcements. So in January, when all those tech companies then laid off thousands and thousands of people, it spiked naturally, and it's actually been coming down significantly. And after having a really relatively calm summer, it's basically jumped a lot. Now, when you look at the Bloomberg, it says it's jumped 266%. That's meaningless. The point is it basically went from zero to very high. The problem with all that, Steve, to complicate things, is that we actually got really good consumption data. So real personal spending beat expectations, and that was 0.6% for July in the US. The Chicago PMI, which is a pretty important indicator, also beat. And so you're in this. It hasn't really changed my view on where I think the U.S. economy is going. And I will reference that because of the delinquency rate. So something we don't really talk about that often is delinquency rates. And obviously, so there's different types of debt. There's like auto loans, mortgages, there's credit card debt. And then there's obviously and so you can aggregate those and you can split them up by different types of age groups. And what we're seeing now in the U.S. Is that delinquency rates for credit card payments for everyone under the age of 40 are basically back to way past the highs of 2020. And it's especially alarming for people between the ages of 30 to 39. So auto loans delinquency rates have ripped basically, and they're almost basically into the realm of the 2008, 2009 area.
Shocker.
So it hasn't changed my view on where I think where we're going, which is slower growth led by, not led by, but, the U.S. consumer being the last sort of cylinder in the global engine will finally seize up. And I think you're starting to see some serious cracks. And I would point to auto loans and credit card loans as where that's starting to make itself known, Keith.
One's a point and one's a question. Let's do the point first. It is the job opening labor turnover survey, just to be precise.
I think my brain just doesn't want to know that information for some reason.
No, but JOLT sounds pretty awesome, And the second was a question. Rich, you just said, it looks like growth is slowing quite a bit. Is it your expectation that we hit a recession sooner or later? Like, what do you expect?
I mean, I think it's going to take some time. I think we actually mentioned this, which is there's lots of reasons why it can happen now, but I think the main reason why it's going to continue, where it's going to take longer again than people expect, is because of the incredible budget spending that's done by the U.S. So budget deficits right now in the U.S. are 8.4% of GDP. I mean, that is incredible at this stage in the cycle. And what I mean by this stage in the cycle is like when you have very low unemployment rates in the US are very low. They're especially low for prime age workers, aged between 24 and 54, whatever it is, 25, 54. And normally at that stage in the cycle, governments tend to spend less money. So your deficit will, and if you look at the chart, if they're inverted, they basically go together. More unemployment, you have these automatic stabilizers, unemployment checks, and unemployment insurance. People draw down on all kinds of programs. And naturally, when people become employed, they move away from that and government's deficits start to shrink. Joe Biden, in his infinite wisdom, has blown out this number. And so for the first time, basically in 3 generations, I'm not even kidding about that, like 70 years or so, you have unemployment's really, really low and the budget deficit's basically vertical up to 8.4. And that amount of fiscal thrust in the form of infrastructure spending, manufacturing spending, all that stuff has basically lifted or delayed what I think is a slowing economy. Problem is, eventually that kind of impulse is what we call it, that kind of thrust, that fiscal thrust, eventually peters out. So that's a long way of saying it's going to happen.
Fiscal thrust.
It's going to happen. But I mean,
Steve, I still didn't hear an answer. Did you? I didn't hear it was.
I think it's going to happen longer. It's going to take longer than we expect.
Give us the day.
But to give us the day, I think it's going to happen on February 6th of 2024.
There you
I
go.
don't know
Heard
what
it here
day
first.
it's going to be. Come on. You're going to clip that? You're going to
clip that, Jeff. Clip that.
Well, wouldn't it be great if that's actually when it happened? You're a rock star. You might even get a date out of it. Think about that. Yeah.
Well, yeah. What about the? I don't know, but Rich. I guess it depends on how you splice the data. I have I'm following the Fed whisperer.
Oh, Nick, cool. I've never heard of this guy.
Nick Timiraos. Is that how you say it, Keith?
I don't know.
Anyways, Nick with the Wall Street Journal. He's the Fed whisperer because he basically apparently they don't leak it to the BC Premier, David Eby. Apparently, they all get leaked to Nick at the Wall Street Journal. So he was tweeting that headline inflation, as measured by the PCE price index, the Fed's preferred inflation gauge, rose at a 2.1% annualized rate over 3 months ended July. It was up 2.5% at a 6-month annualized rate and 3.3 over the previous 12. So he's quite dovish. And that's the whisper. So I don't know. Maybe he's trying to get a secret message out.
And so to be clear for everyone, markets are not expecting the Bank of Canada hike next week. They're also expecting that the Fed has stopped hiking as well. So the market is saying, hey, it's done. It sort of ties into what, the narrative you just shared. Let's quickly, I think we need to finish up quickly with my favorite central bank, which one?
The
I don't change. I'm pretty consistent. Yeah.
Fantasyland.
The Europeans. So they're in a real tough spot right now because their inflation data I think it's actually stickier than what some of the American data is showing. But their growth data is even worse. And growth is not even the word should be used. There's no growth. So if you're not growing, what are you? You're contracting, I guess. But a lot of the data over there, it's the stagflation. So stagflation, that's one of the, I guess, the fancy words we use in our world where you're not growing, but inflation is still increasing. So it's caused by supply chain shocks and energy and stuff like that. So, but the central bank can't fight that because a central bank can fight demand, what's where they control with raising or reducing rates, but they can't change the supply story with it. But one of the ECB board members, this lady Isabel Schnabel.
Say that again.
Isabel Schnabel.
Bless you.
Real fast, one more time.
I think it's right. Isabel Schneebill. Schneebill.
Bless you.
Schneebsy.
Oh boy. Good thing September is almost here, hey? That's when people will start listening to us again.
Yeah, that's right.
But the most important point today, everyone, is that one of the ECB board members, she stated that economic conditions today are more dire than what the ECB predicted 2 months ago.
Ouch.
So for the ECB to come out and say that, meanwhile, the ECB is still saying, oh, we need to raise rates and everything. But the euro currency today, what's happening with it? It's my favorite word.
Mullered.
It's getting mullered today. It's just taking it. So the expectations that the ECB are definitely finished raising rates. So we go back to this world again. So if remember, because Powell was quite hawkish at Jackson Hole there a few days back, if the Yanks raise rates again at the next meeting, and the Canadians don't, the Europeans don't, I don't know what the Brits are going to do anymore. Japan is. The Brits will raise. Japan is, they're in their world, and the panda in the room. And again, if you get the Americans raising rates, it tightens. Like that panda is just going to lose it again, because again, we're continuing to see bad debt stories come out of China. But again, that's like what we like to talk about all the time here on the podcast is that even though we're Canadian centric, we have all that going on. But it's also incredibly important for everyone in Canada to appreciate and understand how events from outside of Canada can come in and affect us. And that's what we have right now. So
Speaking of
again,
the panda in the room, a little update here from Beijing over the past 72 hours, trying to open the liquidity spigots to stem the tide over there. But yet income tax cuts, existing mortgage rate cuts, the People's Bank of China lowered down payment requirements for first-time home buyers and some property investors. And they've also been instructing some of their some of their banks over there not to sell stock as well. So I mean, they're clearly
they're trying to stress that people will buy or entities will buy equities. Which, if you're over, you're thinking, I don't want to do that.
Yeah, you first.
Yeah, you do it first. Meanwhile, they're telling banks to lend more. If you're a bank, you're sitting there saying, oh, I don't want to lend any money to these guys because it's a complete circle.
Except they have a gun to their head. So,
Keith, I have a question for you before we go on. Why do you think that the CDS spreads and all of the bond yields over Germany or all the ways that you would measure risk in the bond market for Europe have been so sanguine? Which is a word I know the comments section in the YouTube really like. Have been basically relaxed. Have been tight. They haven't been showing at all. I'm looking at the Italian CDS spread on my fancy Bloomberg, 84 basis points. Why have they been so low, you think?
Well, you got two things going on. First of all, like even though conditions are set up to have a view that, things could just simply go off kilters here, it hasn't happened. And the majority of the market view is that it's always a regular cycle. So maybe the slowdown has been enough already. Again, the analysts at the big banks and at the think tanks and stuff like that, they never predict an extreme market event. It's always the big short guys that come up with that. And when they do it, they're considered to be, loony and crazy for doing it. In hindsight, they are right. So you have that going on, but there's also then within the financial system, the excess savings coming in on a regular basis is still enormous. Like there's always every single day when someone gets their paycheck, the withholding tax comes off, pension contributions come off, and that money has to be invested. And most of it is always going to the bond market. So one of my good friends, he's a bond manager for European credit over in London. And he said, yeah, Keith, like every week I got to spend, 85 million euro equivalent. So you got to buy stuff, and you can't buy the sovereigns because you get paid more by buying, something else. So maybe you got a bit of that going on, Rich. But again, there's a lot of things. Again, big money doesn't move. Once they buy something, they have to sit there and take it. It's the smaller guys, that are nimble. And when the smaller guys are moving, the market doesn't move that much until an event takes place. Sanguine.
Sanguine. You got it.
It sounds delicious.
I think that's a good place to wrap it up. Keith, when's the official recession date?
Feb 4th, is that right, Rich?
That's what I said.
I'll take the 5th. There you go.
I think we're in Q1. Q1 is start to get ugly out there.
A few more fireworks. All right. Well, we got a long ways to go until then, so I'm sure there'll be lots to touch on. I hope everyone's enjoying a good long weekend here coming up. And as always, we appreciate your support. Enjoy the official last weekend, I call it anyways, of the summer. And we'll see you next week.